Okay, welcome to this wonderful opportunity to meet a loan program that very few people know about and a lot of people are kind of scared of. Okay, it is the all-in-one loan, and we've got a special guest today, Dave Herbst with the all-in-one team. He is the VP of the AIO Finance, and this is a special opportunity for you to learn from a guy who has been deepest involved with this loan. And I'm Ricky Khamis, president of EPiQ Lending. I've got Austin and Drake on with us, and Drake, I'd like you to just talk to the young men and women your age that are wanting to get in the market, but they're a little scared, and talk to them about why you got so involved with this loan.
Well, I'll start off by saying that when I first got licensed, it's only been about 6 months. I was tasked with going through our database and sorting the files. So when it comes time to refinance somebody, it's just a quick call and the file is all ready and we could refinance them. And I would always see the all-in-one loan program code with an 8% interest rate attached. So it kind of deterred me, and you'll figure out why later, that it deterred me from really going in and studying it. I'm like, why would anybody do an 8% interest rate? Like, I didn't understand it. So then, I did my due diligence and started learning about how it's a principal first. I don't want to spoil anything, but it's a principal first payment and it lowers the effective rate. It depends on the client, but it's all about the effective rate. And as a young person, crypto, all this stuff, financial products. The world's changing and it's becoming way more technologically advanced. And after seeing the all-in-one loan, I don't know how it's not the industry standard, and I'm very excited to have Dave here to go through it with all of us. So thank you very much.
Awesome. Thanks,
Well
Drake.
said.
Austin, so you're the older brother. You're right at that age to be looking for your first house. And there's so many programs out there that are the cookie cutter, what I call pay forever loans, right? Yeah, you can put a 30-year fixed on it, but someone refis it 4 or 5 times. Every time they refi, they kick the can down the road, 30 more years. What is your opinion of the all-in-one loan, Austin?
I think if you can do it, you 100% should. It's a loan that you can pay off, and depending on your income and how your income's coming in, you could pay off in as low as 2 years. We had a client that literally paid it off within a year because they Airbnb'd it out with the AIO and just pumped their Airbnb money into it. So if you're investing and you want to invest in real estate, what I would do is I would use everything, excuse me, to funnel through the AIO loan. Like my car at a 20% or whatever, 10% interest rate. As soon as I have enough to pay off my other debts, I would funnel it through the AIO loan and just keep paying the AIO loan off. So it's a great tool to help save money.
That sounds really smart. Now, the other thing that I want you to know, Dave, is all three of us are certified mortgage advisors. So Drake got licensed, and within 30 days, he got licensed as a certified mortgage advisor, along with Austin. And as a certified mortgage advisor, supposed to put people in the best, most optimal financial position. Well, is that paying a loan 50, 60 years? Probably not. I don't know that that's the best financial way to put somebody into a home. So thank you for being here. Really appreciate you taking the time. I know you're a busy guy, and I'm really looking forward to this.
No, my pleasure, Ricky. You guys are awesome. It's my pleasure to be with you. I love everything you're saying because it's you all have come to a place where you recognize the power of the product. Drake, you hinted on it. It begins with something as simple as principal paid first. It's just, such a simple concept. There's no law that says a lender can't change the way money is treated or applied to a loan. There's no law that says you can't do that. So why is the industry so slow to change and put the consumer ahead of the system? For a lot of different reasons. That's probably for another show, Ricky. We could maybe organize and talk about those topics, in a different forum. But the reality is that from the consumer perspective, just because it's been this way for a long time It doesn't mean that it's the best way. It doesn't mean that things can't get better. And if we adopted that, idea or paradigm for everything, we'd all be still using rotary phones. There'd be no cell phones. There'd be, we'd be, stuck way in the past. And, the all-in-one loan just represents innovation. There's an old adage, and it goes like this, that money, like wealth, doesn't disappear. It transfers. Money is always moving. And to Drake's point earlier, as things evolve and technology, plays a deeper role with our day-to-day lives and our activities, the velocity of money is accelerating, meaning that you've really got to pay attention. You really kind of have to. The days of just having a checkbook and your checking account, your savings account, and maybe a 401k or a pension fund through a workplace. Those days are kind of gone. The simplicity of life are sort of gone, or they've got left behind, over the last couple of decades, I'd say. Nowadays, it's more important to realize how you can benefit from, your own income, and you should be benefiting more than anybody else from your own income. But that's not the way the system is designed. So, the all-in-one loan just represents an update so that we can put the customer, the borrower, the regular everyday, individual who can qualify for a mortgage ahead of the system. And that, why is that important? It's important because we need it, you guys. It's just, we need it. People would be better off if they had more money available. And that you can't snap your fingers and suddenly make more income. You can't suddenly, get some inheritance that doesn't exist. Life is pretty difficult and it's getting increasingly more expensive. So how do you have more? How do you gain more? What's been missed along the way, I think, in this path and this journey for people, financially speaking, is that, that you spend a lot on your debts, not just the principal balance, but of course the interest that comes with that. When you borrow money, it costs you money. And, the old saying, dollar saved is dollar earned is true. I think it's just lost upon people now. I think people don't think about money that way, that we only really focus on the gains and the investments and things like that, right? And there's technology centered on those things. That's great. Go build your wealth that way. But you also build net worth by reducing the cost associated with money owed. If I were to save $5,000 in interest on a debt versus or have an option to earn $5,000 in an investment, I'm better off saving $5,000 in interest cost on a debt because that savings is not taxable. And so your gain is better. And that's a strategy that people, I don't think, incorporate into their everyday lives for good reason. The products and services on the lending side of our nation aren't designed to make that easy. And that's where the all-in-one loan comes in. In fact, Ricky, do you mind if I share some information? I'm going to pull up a PowerPoint. I think I'll just run through that. If you're okay. Yeah.
No, definitely. Thank you.
Okay. Yeah, of course. I'm going to share my screen. I'm going to pull this up. One of the things that I believe people are very surprised of once they learn about the all-in-one loan is that it's been around for a while. It's not a new product. It's not a new idea. This journey for us as a company began in 2002. And the origin story briefly is that this concept and this type of way of managing money and debt has existed for decades already, decades even prior to us learning about these types of programs. They exist throughout Western Europe. They exist in Canada. They exist all throughout some other countries, New Zealand, Australia, India, commercially also here in the US. Big banks and big businesses get to use their capital in a very unique way to reduce the cost associated with their liabilities. Okay. And that's all the all-in-one loan concept is. And I'll talk through that here in a few moments, but we launched this product originally as a brand name, the Home Ownership Accelerator in 2005. And what we proved to set forth in doing was right. We were improving the lives of our customers, financially speaking, creating liquidity, greater control, greater cost reduction opportunities. And then as the 2008 financial crisis unfolded, our customers and us as a company were positioned exceptionally better, and that ultimately catapulted us to the level we are at today, which is a much larger company, one of the largest in the nations in terms of a lender. And it's as a result partly of this program because it is better for people. It puts the customer ahead of the system, period. It's the only mortgage product, the only loan product that puts the customer ahead of the bank or the lender, built by us who are consumers. We're privately held, family owned and operated. And that matters because we think differently. We think as consumers and homeowners, not as banks and big lenders. Okay. And so as we advance, over time, fast forward to today, we rebranded the product to the all-in-one loan. It's much easier to remember, much more synonymous or reflective of how the product is structured. And that's a trademark brand name, all-in-one loan. And, fast forward to today, we help tens of thousands of families annually, and we've done that over the last 20 years with this product with no reported losses. This is a hard loan to go delinquent or late on, and certainly very, very difficult to end up in foreclosure because of the way it's structured. Because again, we advance the needs and the interest of our customers ahead of our own, and that's very special, very unique. Let me walk you through a few slides here and just give you some more information. What it finances is residential real estate. In the future, not too distant future, you guys, we're going to have this also available in the commercial space. And we'll talk about that. That's all I'll say during this call, but that's exciting. It makes sense for commercial as well. Residential real estate, that's just your single family homes, condominiums, 2 to 4, unit multifamily homes, primary residences, second homes, investment properties, phenomenal. As Austin pointed out, for investors as well. But our bread and butter is our primary market for this product is just people with their primary residence. It's the vast majority of our production on a monthly basis. About 80% of our loans on the all-in-one loan are primary residences for people, and about 55% of the people that get an all-in-one loan are refinancing out of their COVID era interest rate mortgage in which they have 20 something years left on to get into a better product that puts them ahead, gives them a cut in line financially. So, but it's also epic. It makes sense for real estate investors because it grows your positive cash flow position in real estate owned, and it keeps that money liquid. I'll explain that in a second. You can use it for purchase or refinance. You could also use it for construction. You want to build a new custom home? Use an all-in-one loan to do it. It's a one-time close, super convenient. And we lend as high as 90% on a purchase or rate term refi. We go as high as 6 million. Proprietary program. We built the guidelines so we can make exceptions and things like that too. So we think outside the box. One of those features is asset depletion. We can use assets as income to help people qualify without them having to pledge those assets or liquidate them. It's phenomenal. It's extremely aggressive, but it makes sense for the type of customer that benefits from this product. Delayed financing, cash buyers can take an application out to get that cash back out without any seasoning requirement using this product. And of course, it's available nationwide. Why it's different is really the outcomes. We speak outcomes. We don't just speak payment, right? I think that's the mindset of most consumers, most people, everybody. When they think about mortgages, we instantly think about rate and payment. I understand that. Those are the only levers or mechanisms that people, I think, believe they can somehow have a choice with or control. The reality is there's other variables to a loan program, and we focus on those other variables. I'll showcase that in just a moment, but the outcome is what we're focused on. Yeah, you need financing for a home, whether it's a new purchase or you currently own a home and you got a mortgage on it because you don't have enough money in your checking account or savings just to write a check, and that wouldn't be altogether that safe either. So yes, people tend to need financing in order to possess real estate. That's an easy box to check. We do that, but it goes further. We think about where somebody's headed in their life. What do you need to do? What's your time horizon for retirement? Do you have kids? Are you planning on spending money on their tuition cost? Do you need help? Do you have other debts, right? Do you have other obligations? Are there other emergencies, unexpected things that might occur in your life for the next 10 years or beyond? Of course, all these things exist. We know that about our customers. We know that about the market. So why not build a financial tool that allows them to navigate? Because that's what the all-in-one loan does. Compared to a conventional mortgage, it pays off 2 to 4 times faster. So it changes the trajectory of pay down. Because if you can reduce what you owe faster, you reduce the cost of the loan. You reduce the amount you have to spend of your own income on that product. That's what everybody wants, to pay the least amount. It goes beyond that. It also allows all this flexibility. You can utilize your home's equity money over the term of the loan product. So medical emergencies, want to buy a new home, maybe build an ADU in your backyard and rent that out so you can build some income, some residual income. This product is a flexible financial tool that allows people to maneuver and navigate life without having to sit there and go chase loans and chase interest rates and chase, financing cost. So it's a phenomenal opportunity for people. Again, yes, we check the box. It provides financing. Got it. That's the easy part. Goes beyond that. This is the only mortgage designed to pay off in 5 to 15 years, and sometimes even faster, without requiring a higher payment amount each month. So no change or disruption in somebody's lifestyle and budget, but it pays off faster automatically because the way it treats money. It can lower interest costs. As a result of lowering what you owe, you reduce how much you have to pay or how much you're going to get charged. And it does that without relying on lower rates. What if you didn't have to wait for rates to come down in order to pay significantly less? This can save somebody so much money in interest that it can be the equivalent of getting a mortgage that's below 3% today, in today's environment, and even lower. It can lower monthly payments, or it does lower monthly payments with principal. So as you pay down principal, your payments come down with it. Why is that special? Because you're left with more of your income. Wouldn't it be better if you had more of your income available to you at the end of each month? More and more and more and more. So it grows your positive cash flow every single month without you having to earn more. It does that automatically. And that's just part of the structure of the product and the principal paid first component of it. And it also is liquid. It provides access to equity money, or the money you applied towards your mortgage. You can pull that money back out 24/7 over the term of the loan without having to refinance. So it's phenomenal. And that's what people need. They need a financial tool. But why do this, you guys? Just briefly, I think it's important. Why? The why part of the discussion about lending is missing. We do not talk about why, and people don't raise the question. Somewhere along the line, over the last 80, 90 years, people stopped asking why. We just sort of subscribe to what's been around for a while. That's not okay. What if we stopped innovating with telecommunications? You wouldn't have a smartphone in your hands. You know what I mean? What if we just stopped innovating automobiles? We'd all be driving 1972 Pintos, and that would suck. So think deeply about everything else around your life that has evolved since the 1930s, except for the way we mortgage real estate and pay for real estate. It's about time, and that's what we've done. The elephant in the room is that the mortgage is the biggest cost people commit to in their lifetime on a personal level. It consumes about 40% of all the income, the net income that people have available to pay their bills with and just live on a monthly basis. It's a substantial portion of our lives, and we have to make room for it. The sad part about mortgaging and owing money on real estate is that along the way, our discretionary money, the money we have available for savings, has also collapsed. It's about 4%, actually slightly less than 4% of our money, our net income that we have available. So people have less money to save, and that's not okay. We know that the average duration left on an existing mortgage out there in the marketplace today is about 25, 26 years, but yet the average age mortgage borrower is middle aged. They're in their 50s, about 55 years old. Average age buyer in the United States is 56. Average age first-time home buyer is about 40 years old now. Obviously, we're going the wrong direction, you guys. So the why matters. We view the mortgage as a company. We view the mortgage as not just a mechanism to own real estate, but also a financial tool. It's an active participant with financial outcomes in somebody's life. So let's treat it that way. Let's talk about it that way. Let's structure it that way. Housing affordability is an issue. We know this. It's in the headlines. And what's the answer? Wait for rates to come down? No. We've had access to low rates, and all it's done is accelerated debt. It's just increased debt. Yes, rates are one of the components, so low rates do help, but it's not the answer. And of course, more inventory being built is not going to happen overnight. And like I pointed out, people can't just snap their fingers and make more income to create affordability. So clearly we have an issue that needs to be solved for. We also know that we've gone from being a nation where we build generational wealth to a nation where we build generational debt. And that's sad. Gen Xers, my generation, owes the most amount of mortgage debt today in the US. Baby boomers, that's sad. About 30% of the total outstanding mortgage debt, which equals about $14 trillion. $14 trillion is owed on our homes today in the US. 30% of that, roughly 30% of that is owed by baby boomers still. So people that are trying to retire or are retired. And oftentimes they've got to move out of state and downsize because they just can't afford the lifestyle they want to lead in the home they would love to live in. That's sad. Even scarier is the millennial generation, quickly catching up to both the baby boomers and the Gen X in terms of their indebtedness. But they've had a lot fewer years to grow their income and establish their assets and whatnot. So, again, we're headed in the wrong direction. These are all tells, if you will. These are signals to us that something's got to change, not rates. Let rates be rates. What's got to change is how money is applied, how money is treated. Retirement savings is in deficit. People are off track. We know this. It's studied by the government. We study that and publish a lot of articles and white papers regarding this topic and how the mortgage plays a role in this. About 55% of working age households think they'll never be able to afford retirement. And about nearly 80% of working age households believe that the nation is in store for a retirement crisis, of an actual financial crisis. And again, there's a lot of studies out there that support our thinking. Here's the traditional thinking. We know that when it comes to mortgages, people just want to pay the least amount. We get that. So what do? They focus on interest rate to do that, right? To lower their payments to the least, possible required obligation. And that's it. They check that box, close their loan, and they go on. And then they'll probably recycle that because maybe rates come down or they have a need for some more money. Something occurs in their life where they change their mortgage about every 3 to 5 years or so. This is misguided. This is not complete. Rate is important, but it's only a third of the mathematical equation. Mortgages come with 3 variables. Same with all financial products. All financial products, whether you're investing money or you're borrowing money. There's 3 mathematical components to that product: rate, principal, and time. That's it. Let's stop focusing so exclusively on interest rate and get back to focusing on what matters the most, which is principal balance and the time you owe a principal balance. That's the more effective way to lower cost, not rate. Give you a quick example. If I was to give you 2 options, loan A and loan B, you can clearly see that loan A comes with a higher interest rate, much higher interest rate. Back to Drake's original comments about when he was first exposed to this product and how his focus was rate immediately, naturally. Everybody does that. What are the rates doing? And it's sort of a fear-based approach, right? We clearly need or want to look for the lowest rate, but does that really matter as much as we think it does? Clearly not. What matters more here is reducing the amount of payments we have to make on a mortgage in total. So loan A with 120 payments paid off to 0, so 10 years, saves us money over a 3% mortgage with 360 payments, saves us a little over $10,000. That's phenomenal, right? About $12,000 in total. What people don't recognize is how low rate loans still cost us high amounts of money. So Ricky, you had said something, a few minutes ago in the opening, and I want to add to it. What really matters is the amount people have to pay for their loan. We ask the question all the time, what matters to you most as it relates to your decision-making process with a mortgage? The rate that comes with your loan or the amount you've got to pay for your loan? The dollars, the money you got to earn, work hard for, and then spend. Which matters more? Because interest rates are just a number. The rate on your closing disclosure and on your documents is just a number. That number gets applied to the rest of the terms, the balance and the time. So what does matter most? I'm telling you, mathematically and financially speaking, the balance and the time matter more. So let's stop kind of doing things the old conventional way. The product structure of the all-in-one loan combines 2 everyday products together that we use already, the best parts, best functions of a mortgage and the best components of a checking account into a single financial hub. That's what an all-in-one loan is. So let me repeat that. The all-in-one loan combines the functions of a mortgage, the financing people need, with the functions of a personal checking account linked with the mortgage, all into one singular financial hub for ease of use. And this makes a lot of sense for a variety of reasons. Now, the mortgage is powered by a first lien position line of credit, very different from your traditional HELOC. This is a first lien position line of credit, provides access to money for up to 30 years. That's extraordinary. It's one of a kind. And it clearly offers competitive interest rates. But again, it's not rate focus. That's not what drives benefit and cost savings. Time and balance does. So let's focus on that. So with the all-in-one loan, I'm going to repeat that slide. Let's go back. The line of credit looks like this as a structure. We finance up to whatever the customer can qualify for, up to our limits, but the credit limit is available at that original amount for the first 10 years. And there's no balloon payment on this loan. There's no amortized payment structure. So unlike a traditional HELOC that cuts you off after 10 years and now you got a P&I payment, this does not do that. It remains available and liquid for 30 years. We start reducing the credit limit after the 10th year evenly each month. So this keeps people liquid over the course of the the loan. We also have a Texas version for Texas primary residences that gives 25 years worth of draw access. And then if there's a balance owed after that time, it is amortized for 5. And that complies with Texas state homestead rules. But what I want to be your takeaway as you're listening to this is that it's up to a 30-year draw, 30-year accessible line of credit that comes with a checking account embedded in it. And this is a powerful financial tool. The checking account, of course, is powered by an FDIC insured consumer account, providing 24/7 access to money, which is stored inside the mortgage. And this includes all the bank features that everybody would expect. ACH transferring, ATM debit Visa cards, online banking, bill pay, everything, Venmo, Zelle, all the same features, check writing, all integrated with the mortgage, which is phenomenal. So how we do this? Okay, I want to make sure everybody understands that in the normal system, our liabilities and our money are kept separate, right? This is the standard traditional way, the paradigm. We bank and borrow in separate accounts. It's part of the problem. And we all know how it works. We earn, and that money comes in. And then, as you know, most of it's spent on a mortgage. And then, of course, we have living expenses, which constitutes about 56% or so of our money. And we spend out on those things each month. And this process repeats. We get paid, maybe get paid a couple times a month. And then we spend our money outbound on our debts and expenses, including our mortgage. Slowly but surely, any residual money that's left over may build up, and we tend to either blow it, spend it on things we don't need, or push it over to our savings account. Either way, this is the process. Here's something that I want people to think through. Checking accounts are probably the most powerful, undervalued financial tool people use in their lifetime. The reason why I say that is simply because it helps manage a high volume of money. Your income is your biggest financial resource throughout your life, period. You will manage more money in your checking account throughout just the course of 5 years than you will owe on your mortgage. So let me repeat that. You will earn more money and use your checking account to manage those dollars, more of that within 5 years than you owe on your mortgage. So people do possess the resources already to make greater progress on their debts and lower their cost and grow their net worth. But most of this money is non-investable, right? We need to keep it liquid, and that's a key advantage of a checking account and the all-in-one loan. But we also know that all this high volume of money that we earn over time, it earns us very little in return, typically 0 to 3%, maybe some high yield checking accounts out there. But I think the national average is about 0.07% and reducing. So that's the way it works on the checking account side. On the mortgage side, traditionally, we make our payments each month, but very little goes towards principal, right? We make very little gain on reducing our balance. Nearly all conventional mortgages come with a forward amortization schedule. This is what impedes our progress. The forward amortization schedule, the process or the structure, the payment schedule defines how much of your money is going to principal versus interest over the entire term of the loan. This impedes progress. It's like putting speed bumps on the freeway. Well, what happens? Suddenly everybody stops going 80, 50, 60, 80, 70, 80 miles an hour, and everybody's doing 15 miles an hour. And that slows you down. Now it's going to take more time to get to the airport. It's going to take more time to go shopping. It's like speed bumps on the freeway. That's not okay. So the amortization schedule needs to be removed, and that's what we did with the all-in-one loan. We also know that most of that monthly payment is going to the interest cost early in the term. It takes about 19 years before our payment converts from mostly interest to mostly principal. And we also know that we always pay higher interest on our checking accounts in our mortgages than we get paid on our checking accounts, right? This is the adverse relationship or lack of relationship with the traditional way we do things. So the all-in-one loan simply removes this invisible barrier that exists between our checking account and our mortgage. And we combine them together so that income can flow freely directly to the mortgage balance, filling up the debt. The faster that debt or that deficit is filled up on a daily basis, the less money you have to spend with the lender. It's just that simple. Money being deposited into the all-in-one loan pays down the balance. Money kept available for regular spending needs every single day as normal. There's no longer a traditional mortgage payment. Your deposit was your principal payment. Interest comes later. It comes after the month is ended. Daily, simple interest totaled up after the month ends, charged back to the account on the 21st of the following month. If you have this loan now in December 2025, your December interest cost won't be charged or due until January 21st, 2026. It's in arrears. We keep it in arrears 3 weeks further so that money continues to compound in benefit and principal reduction. So again, people can pay off fast. They can use it for other things buy another home. What we've proven over the last 20 years, guys, is that this loan helps people buy real estate, reinvest in real estate sooner in their life and grow their net worth more aggressively with no change in their lifestyle, no change in their budget, not requiring them to chase interest rates and not requiring them to be able to make more money, just using their current budget and accelerating their trajectory. We also, like I said, use this or have it available for construction loans where the draws come off the line of credit to fund the builder and the project. And there's no second conversion or modification or requalifying. It's a one-time closed construction product. Phenomenal. So imagine, your home's being built and you're proactively flowing your income through your construction loan, paying your bills from your construction loan, building equity in the home before it's even completed. And once it is completed, you're liquid. So you can use your equity or credit just to furnish it, finish off the hardscape, do all the other things, or just continue to pay it down fast and lower your monthly cost obligation. The outcomes are enormous, significant. Yeah, I just don't want that to be lost upon people. It's the outcomes that we're focused on. What do people need to achieve financially? How can we help? Well, it doesn't get any better than a principal paid first mortgage that recomputes interest on a lower daily balance to help people pay less and build equity faster. It's what I call a meaningful transformation. It changes the way you think about your money and, of course, debt. If you pay it off in 11 years or 9 years or 7 years or 6 years, or if you're on that trajectory, it just means that you're in a better place every single month. How would you like to save a couple $100,000 in interest cost? And this is my last slide I would show and share, Ricky, this QR code, if somebody wants to take a snapshot of this as they're listening to this and watching this video, this just gets access to a Dropbox folder that's it just has a bunch of resources in there that's makes it easier to understand the product and go deeper. White papers, articles, you name it, testimonial videos, case studies, even some collateral that can be shared and used. So I know that took me a little bit there, guys, but
Amazing.
I certainly just want to cover the information and kind of get people to go, whoa, this is different. I got to know more.
It was as good as I thought it was going to be, Dave. And, again, I really appreciate you taking the time because I know how busy you are. And,
yeah, my pleasure.
But we're just trying to spread the word. We are, we're spreading the gospel of the AIO. And,
that's right.
We really do believe in it. And, from the creator, if we're going to go along the gospel lines from the creator, we wanted to hear from you. So thank you.
I've been called worse, my friend. I appreciate that. I was doing it.
I don't doubt it.
I was up in, where was I? I was up in like Portland, Maine, doing a presentation in front of a large audience in an Italian restaurant. And I was the host who introduced me as the Godfather. And it was very fitting for the setting. We were in this old school Italian restaurant. I was like, man, I'm starting to feel like Al Pacino now. This feels pretty good. But, the truth is too, let me just kind of close with this. I am also a customer of the all-in-one loan. I had to have it after learning about it. The year we launched it in 2005, personally, it's helped me out significantly. So I'm not, just a product manager and developer and somebody that, just wakes up and thinks about this loan as a job. It's a passion of mine. It's a lifestyle of mine. Because I see it as solving some greater financial issues, if not the American economy in the end. And let me put it this way too, there's about $14 trillion right this moment residing in checking accounts and savings accounts and money market accounts, just loose, low interest yielding accounts. Right now, about $14 trillion in consumer deposit accounts. We owe $14 trillion on our home loans today. Imagine if everybody, all about 90 million households, had an all-in-one loan. All that stored money that's earning them lower interest and they're paying out on their debts. What if it could consolidate into one financial hub? The United States of America would have zero mortgage debt, you guys, zero. So what would that mean? It means that we would probably also begin to solve our retirement income crisis that's getting bigger and bigger and bigger. We would probably be able to lower the cost of things like college tuition for children. Our credit card debt would be paid off in an instant, or pretty quick, because that's only $2 trillion worth. Our student loans would not be as burdensome as they are. The whole idea is to help, people just simply get ahead, have more of their income left over after the end of the month so that they can do bigger and better things with it. Okay. And that's important to us, as you know. And so unlike any other lender, we did something about that idea. We all know that's good, but we did something about it. And that's what this product is. And of course, your listeners have it available through you guys, through your team.
Love it, man. Thank you so much, Dave. Appreciate you.
Can I just point
course.
out one last thing?
Of course.
Is imagine a universe where there's 4 people that are passionate about a loan, a mortgage. That's how powerful this all-in-one is that there's people that actually are talking about it in terms of ending national debt. Like that just shows how powerful this tool is.
100%. It moves people. You know, again, I call it, there's reasons, you know, I don't mean to sound too philosophical, but there are reasons why people do what they do, right? And you know, when you break down just decision-making process of with our finances, we all know there's a lack of financial literacy in the United States. We know that. We don't really teach kids how to really manage their money. And so we kind of grow up learning it and bumping along, and hopefully you find some great people that are smart and can help you. But even worse is that the systems and the products and the services and the financial side of our lives are not innovated very frequently, especially in the debt side. And I think we've lost our way a little bit. And, you know, it just comes back to like, what can we do to help people get ahead and get that financial cut in line in life, if you will. And as a lender, we can either decide to do what all other lenders do, which is just to wait for rates and, you know, and loosen up credit policy, you know, allow lower credit scores and higher LTVs, things like that. Hey, I'm all for helping people and more people, you know, get into a home. But at the same time, we have to recognize that what we do for a living is we put people in debt. And we should not only be really good at helping with that process, but we should also be very, very good, if not better, with helping people get out of that debt. And that's important.
Awesome.
Yeah.
Thanks a lot, Dave.
You're welcome. Thank you, guys.